Such business is a term you'll see and read a lot as you download the file that I shared. What this means is that there's 3 safe harbor tests. All you have to do is pass one. So for the business owners, there's 20% of you on this right now that are business owners trying to figure out, can I start a business or can I expand my business and benefit from both capital attraction as well as my own, maybe if I'm taking capital gains from another thing and I'm reinvesting to expand one of my own businesses and I do it in a zone, how do I qualify? Well, in the original language, it was kind of unclear. It said 50% of your gross income must come from inside the opportunity zone, but that was nebulous. It wasn't really clear. They've gotten a lot of commentary. They've taken that to account, and now there's a 3-test, safe harbor test, that if you qualify for one of these, you're good. And so you can pick any one of these or more than one, and your business will qualify as opportunity zone business in such business. What that means is 50% of your services or hours that are paid via W-2 or 1099 are within the QOZ. So example, I'm a startup software company. I've got people that are offshore developing in India, but I've also got designers or front-end people that are developing and working for my startup, and I put my startup in where I'm at right now, which is Old Town Scottsdale inside of an opportunity zone track. If I build my startup here and I have 10 people that I'm paying either via W-2 or 1099, and 5 of them, meaning let's say they're all making the same amount of money just for simple math, if 5 or more of them are coming into this office and working from this office, whether they're W-2 or 1099, I qualify. So this allows, now my product's being sold all over the world, right? So I'm a SaaS startup. So what this solves is it doesn't disincentivize software companies and service-oriented companies that may have a global client base that is not in opportunity zones from being able to qualify as an opportunity zone business. This is huge for, especially when you're talking about economic development and the purpose and intent of this, which is to engage new communities and new innovation in parts of the world that aren't Silicon Valley or New York or Boston. And so that's one. The other way is a 50% of the payroll or contractor expenses. Again, maybe an agency, something like that. And the third is tangible property and operations. So think of a landscaper. If I put my headquarters or my warehouse and I have my operations team and my employees and all my equipment here, but 90% of my employees are out mowing lawns all around the town in non-opportunity zones, as long as my tangible properties and operations staff are in my qualified opportunity zone footprint and in my building, then I qualify. So again, providing the ability to have a headquarters and job creation inside the zone, even if that job and that service is consumed in non-opportunity zones. One of the other things that they're receiving commentary on still that is very interesting for e-commerce type businesses or people that are inventory heavy is that right now inventory in transit has been deemed as yours and will add to your 90% qualified zone asset test, even if it's in transit. So this is good because, again, people were worried about what if at the end of the year I've got a bunch of product that's on trucks outside of my office, outside of my warehouse that's in a zone, and it's not yet at my customer. Am I going to pass or fail the asset test? What they're saying is as long as it's in transit, it's still yours. And if it left your building and your building was inside of an opportunity zone, it counts. What they're also looking for, and I think they're leaning to based on how I read this update, is they're looking on whether they're going to remove inventory as part of the numerator denominator asset test anyway. That would be simple and a lot easier from a regulatory standpoint to maintain, and it would be a boom for people that want to run e-commerce businesses and things that would just be optional. So I think they're going to lean that way based on how I read it. I don't know. July 9th, we'll all know. All right, winding up today, and then we'll get to a couple of your questions and call it a good session. Substantially improved. This goes to Jonathan's earlier part 2 question. 100% above basis is what the amount is that you have to invest in a property in order for it to be considered substantially improved, and that means it would qualify. So again, if you bought a piece of property for $1 million, and we'll talk about this, land is excluded from this, which is great, especially in urban areas where land is the bulk of the cost. If you bought a building and the building itself had a basis of $1 million, you need to put $1 million into it. But if you bought that building and the land that it sits on for $3 million, you only have to improve it $1 million. That's essentially the way to read this. So the land value below the building of the pre-existing structure does not get included in this basis as it relates to what it is like to substantially improve it. And that's huge because part of the intent of this law, again, is to revitalize areas, historic neighborhoods, things that have fallen into blight that at one time, maybe in a different generation, were thriving. And so this really solves that problem, and it allows capital and funds to look at that and see that as possibly appetizing. The time limit from acquisition to complete your substantial improvements is 30 months. This way you can't sit on it and not do anything. Along those lines, it's very clear in these new updates that they have taken away the risk of speculative land banking as part of the anti-abuse provisions. And so there's a lot of language around that and the different ways that they're attacking that. But the net of it is that there are anti-abuse provisions in place to prevent this speculation. You must substantially improve that land for business or trade. The example given is you can't just purchase a strawberry field that's inside of an opportunity zone as a going concern and not put substantial improvements in it. So, that's the way they're landing down on land banking. Now, debt financed distributions. Jonathan, this kind of touches on some of your question. This is another big enhancement here as it relates to providing for liquidity to the LPs in the fund or to the people that need to pay their taxes in 2026 but may not want to divest the asset. For fund managers that are trying to figure out how to tier out distributions to allow for those things and also not have capital calls. And so debt finance distributions have been regulated and approved. What this means is that qualified opportunity zone funds can use leverage to pay out distributions. Those debt finance distributions cannot exceed the investor's original basis. That kind of makes sense, as increased by the investor's share of the debt in its qualified opportunity zone fund. So based on your pro rata share of the AUM that fund has under management, you have your basis and then whatever your gains are. And so the fund can take out debt or leverage up some of its investments to pay out distributions and provide liquidity. And yet, as long as it's not over that, they're not going to have a cash out trigger. So I'm going to go to questions. This is where you can find me. If you want to book a one-on-one call, if you're an accredited or if you're a fund manager that is potentially nationwide in markets that we are not, we're primarily in the Bay Area, Rocky Mountain Southwest, Chicago, Boston, and South Florida. And so those are kind of where we're investing at present. Doesn't mean we won't expand that, but that's where our current deal flow is. If you're a fund manager looking to syndicate with experts in that market, feel free to give me a ring. If you're in markets that we're not and you'd like us to look at syndicating, please give me a ring. If you're an accredited investor and you're trying to find a home for some or all of your capital gains, obviously, hello, I'm Chris. Nice to meet you.